Hi, everybody. This is Young Nguyen from Advanced Property Strategies, and thanks for this episode of the podcast. I've got a dear special guest, Michael Matusik. How you going, buddy?
Good yourself?
Yeah, really, really good. So Michael used to be a Queenslander. Now he's gone to the dark side. He's in Tasmania in sub-zero degrees, but I'm sure he's living it up, living the dream. Isn't that right, mate?
Yeah. Oh, that's fine, yes. And I spend a fair bit of time on the road and still in southeast Queensland, but not right now. So anyway, it's cold here. It'll be sunny this afternoon. I will do some yard work, and you never know, I might even go for a bit of a paddle and even do a bit of fishing. So that's the beauty of living here. You can easily get to those type of places and work in the evening.
Yeah, that's it. And you've created a business where you can work remotely and still keep in contact with a lot of people and keep on track of a lot of things, isn't it?
Yes, there's technology that allows that, but I want to stress and to your listeners that it's vital that you actually look at real estate and you understand those local markets. And that the only way to really do that is to spend time in them. You know, when we do work, we spend a fair bit of time not only looking at estates and proposals and so forth, but even sitting in coffee shops and observing and spending time doing that. You can't escape the fact that it is real estate rather than something that's like a share that you can, you know, not blindly invest in, but do it more remotely. So whilst my business can be a lot of the background, a lot of the work after those field trips can be done at any hour, and there's type of reporting and Zooming and those type of things, meeting with people and particularly visiting properties are important.
Absolutely. Absolutely. And look, one of the reasons I am excited about having Michael on this particular podcast is in my 20s, I think I was 23 at the time, and I started working for a property development company. I started reading Michael's Matusik Reports, and it was definitely an expert, and he was looking at certain places and certain precincts in southeast Queensland at the time. And I thought, you know, there's some really, really good logic to this. It's not just personal in terms of his point of view, but it was researched based on local information as well as statistics. And here's the thing that I find is fascinating with Michael's point of view is that his and mine are very, very similar, except he's a lot more scientific. And I think I'm a bit more research based on talking to a lot of people, and we conclude the same things, which essentially makes me confide in my own beliefs and conclusions. And that's what we want to thrash out today. So, Michael has a background as a town planner as well as a property analyst. He's involved in multiple businesses as well. He does housing and demographic reviews and outlooks. He's been doing it for about 30 years, called the Matusik Reports. So a little bit, you want to share with us, Michael, about what you do in the marketplace on top of what I've mentioned there and in layman's terms?
Thanks. I'll give you $100 for that introduction. Okay, thanks for that. Yes, you can tell by my bald head and grey beard that I've been putting up with the development community for some time. Not always sort of a bed of roses. My bank account tells you that I'm independent, so I haven't agreed to do certain things. So basically, the best thing to do for listeners who don't know who I am is to go to my website, which is matusik.com.au, and that's matusik.com.au, and sign up for what's called the Matusik Missive. I write something once a week on a Tuesday. Fair bit of effort goes into that. They're normally 2 to 3 minute reads. And once you get to a feeling of what I'm saying and the direction that I'm going in, and then you can search, there's a search button there, so you can search property clock or demographics or golf or whatever, and not everything's posted and kept there, but you can look into it. Once you've done that, then that's the next step. You may want to employ us to find some development sites. You may want to attend one of my master classes, which I do, and I've done with your guys before.
That's right.
Got some more coming up this year. Not as many because travel restrictions as normal. I only run 6 a year. I'd rather do that than do it online. I think it's important face to face. And then there's some range of reports and so forth that I update. I must admit, I'm a bit lazy about putting those on there. And at the moment, I haven't updated some because I've been, locked down and I'm renovating a place here in Tassie, and I'm about to put some new ones on there. So, and they're at an affordable price point. Most of those reports are under $100. They cut to the chase. They tell you what's going on. I'm not the person to tell you that this suburb is hot. I don't believe that. I believe you can buy a good property anywhere, as long as you know what you're buying, and the reason you're buying it. And you might sound a little, smart ass, but a lot of people say, oh, I bought that because, the suburb's going to boom. But why'd you buy that property? And who were you going to rent it to? And what was your strategy? Not a year or two out. Which is kind of the problem with the coronavirus. It's like 10, 15, 20 years away. Why are you buying it for? And then start from that. You can buy a very good property in inner Brisbane in an apartment. You can buy a very crap one. And they can be literally in the same building, but they can be in the same suburb for sure. So you've got to work that through.
Yeah, absolutely. So I know that you mentioned the property clock there, and I know that people can search, but just in basic terms, what is a property clock? I read it when I was in my 20s, and it made some sense there, but until you've got your backside on the line or butt on the line, you've got some debt, and the property goes up or down, and interest rates go up or down. What's your a simple version of a property clock so layman's can get their head around it?
Okay. So essentially, first of all, before we talk about the clock, there's some fundamentals that are important about investing and buying in certain areas. And some of that is basic stuff, like, is the area growing? And is the demand for property increasing versus the supply over time? So if the supply is tight, it's hard to increase the amount of stock in the area, particularly on a river frontage or with a clear view or next to a train station and so forth. And the demand for that type of property is rising. That will trump a property clock anytime. Okay? So some of those fundamentals are important. Now, all the property clock reflects that the property market is cyclical, like all classes of investment. Gets a little confusing because 70% of people buy a property because they want to live in it and have a mortgage rather than an investment. But it still fluctuates, and it fluctuates usually in a 7 to 8 year cycle between peak and peak. It seems to be getting longer now because of the low interest rate environment, because one of the things that makes a cycle move is the cost of money and the access to money. And I'm not saying it's easy to get money, but it's cheaper to get money. So it's having some influence. There's a variety of stages in a clock. It's just, this is the same for shares or putting money, not so much in the bank, but bonds and so forth, is that the first stage is a recovery. So markets improve. That normally goes for about 25% of the time of the cycle. Then there's a upswing, which is where everybody gets excited, and the cab driver, or maybe not the Uber driver, but the cab driver tells you that they're looking at buying property, and you should too. And that's only a short period. That might only be 10% of the time, maybe 15. And then you hit a peak, and that's when the cab driver's bought a property or two and telling you that you're stupid because you haven't bought one. I'm not saying cab drivers don't have properties and they can't afford them. I'm just using as an example. And then we get into a downturn. And a downturn can last, up to 50% of the time, usually 20 to 30% of the time period. And that's when everybody panics. It's like, I've got to sell. And then you hit a stagnation period. Now that's normally 30 to 50% of the time of the cycle. That's when not much happens. Okay. And it's when people say, it's never going to recover. And, I bought an investment property 5 years ago and I wish I didn't because rents haven't gone up and my costs have gone up, and I got a valuation the other day and I wasn't happy with it and it's all crap. And then it recovers. And now how it recovers generally is that the supply of property is less than the demand. The price points become affordable, particularly to locals, and maybe more owner-occupiers purchase at that stage than investors. And then the values start to go up. And now how strong a recovery it has depends on some macros, if interest rates are falling, if wages are rising. Remember those days? And there is an increase in buyer demand. Now that can come from increased migration. That can come from a change in the infrastructure, particularly a hospital, something that adds to wage growth and better jobs. That can also just come from overseas buying. And that's definitely happened in Sydney and Melbourne in recent years.
Yeah.
A lot of my contemporaries want to say, oh, that was because we couldn't build enough stock in Sydney. Largely, no, it was because of not only Chinese, but Chinese mainly, and particularly Indians as well, purchasing property, to be honest, for the future, for their kids, for go to uni and so forth, but for a future position in terms of getting residential status. And to them, paying $600,000-700,000 for a one-bedroom apartment in Sydney, where the locals will say that's way too expensive. It didn't matter because exchange rate, and that influenced the market, and then it rides a cycle again. Sometimes a market misses a cycle. Right. That's important to understand too, because it oversupplies itself. So if we think back at the Gold Coast in the early, late 80s, it oversupplied itself, had too much stock, had too much Japanese investment, and it missed a cycle. The inner Brisbane market, this cycle is probably going to miss a beat. So whilst it's entering or nearly finished its downturn, its recovery is likely to be very mild, because it oversupplied itself. That supplies are sorted out now, but then the values were too high for most people to accept that that's good value. So it takes a lot of push to sell that property. And you probably find that in places like Ipswich as well, for particularly average house and land packages, the next cycle will be mild, despite it being an area where there's a lot of growth coming in Brisbane, because it's oversupplied itself 2 or 3 years ago.
Yeah, very good, very good. And look, there's a lot of information there, and I know that I'm getting my head around what you're saying, because you're covering a lot of ground very, very quickly. And it's very good, because from Michael's point of view, he's done a lot of research, and that's what I like about Michael. It's just based on facts and charts and research and experience as well. It's one of those things. It's one thing to pick up the Financial Review and read some articles, but it's another thing to have that research long term. So
please don't pick up the Financial Review. No offence to whoever owns the Seven Network now, but the best thing to do, just quickly mentioning that type of reading type space. I must admit, I read some summaries every morning. Roy Morgan do a very good free summary of the press. You can go to their website and download that. I scan a couple
I'll write that down.
Roy Morgan, it's quite good. And they're using it to promote their studies that they do in between the press summaries. And sometimes I click through and read that summary. Occasionally I'll go down the road and buy the newspaper, because I want to see kind of where it's positioned in the paper and why it's, there's reactions online, and you say that seems a lot, or that doesn't seem a lot. And then I sometimes pop down the road and buy the paper itself to see. That's like, again, looking at real estate and seeing where it was on the page and on the front page, and what headline it really had, and what spruik was around it, what image, because you don't see that often online. But I do most of my reading that is not to do with property per se. It's to do with wider trends. And in fact, if you go to if listeners go to the website and just click in Easter, each Easter and Christmas, I give a list of things that I think are worth reading. And this Easter was about foresight, not forecasting. And again, I don't want to be big-headed, but I posted a range of things to read about looking through this coronavirus situation, because I'm not surprised that we've had a pandemic. I'm surprised how we've reacted. But if you had sat down and said, where's the world going to be in 10, 15, 20 years? One of the things you could have said, and it's been written about, and Bill Gates has actually said it's one of the biggest issues facing the world, is that we're going to have more episodes, less certainty and more uncertainty, and a pandemic or what's happened is one of those things. And so you need to think through those type of things. So the type of things I read are more macro, maybe because I've spent a fair bit of time in the micro, and I've made up my mind that the property clock works.
I agree.
The things that drive the housing market aren't changing. They might change in magnitude, but they're not changing. What type of jobs we're going to have and so forth is kind of set. So I don't go and read, those investor magazines and say, oh, wow, it's exciting that, to be honest, when you see 24 apartment designs a week, you know the good ones and you know the bad ones, or the ones that are average, and you don't have to revisit them. But anyway.
And that's the thing, is that most investors, they might buy, and I don't know the statistics on this, I'm also loath to quote any statistics because I know I'll probably be corrected by you, but most investors, they might buy 1 or 2 properties in their lifetime. Obviously they're buying an own occupied property maybe every 7 to 10 years, but as investors, 80% of the investors own only 1 or 2 properties in their whole lifetime, if that. So the thing about that is that they just don't get enough exposure to what works and what doesn't work. And I agree with you, the property clock definitely does work. Like I said, I started reading things like that in my early 20s, and I'm 40 now, so call it 20 years later. It's like, okay, there was some wisdom in that. And Sydney, Melbourne and Brisbane have their general differences in their personalities, as does Perth. Obviously you got the mining boom and bust in the background as well. But coming back to what you said before about coronavirus and COVID-19, that's obviously affected the whole world and its economy. Let's just come back to Australia, though, is, what short and long-term impacts has it had or will it have on the property market, at least in the next 6 to 12 months? I know you don't have a crystal ball, but, you're a lot more sensitive to these things than most people, and a lot more researched.
Don't know about that. But anyway, so if we talk the short term, say the next 12 months.
Educated, there you go.
Yeah, I'm self-educated. I was once called a pundit, and I looked it up, and it was a self-confessed expert. So, so if I was to say the next 12 months, and we're going to put a caveat on here, and we don't have a second wave, or if we do, it's very mild.
Yes.
We kind of will know with these rallies of the weekend, and if there have been a couple that were, contagious is the wrong word, but have
infectious,
infectious, and they went, and it doesn't circulate much, then we kind of have at the moment, the government's putting it down, saying, it's going to stop. We're going to, the restrictions are going to take longer and all the so forth. But the opposite could apply. So we'll just see what happens. But assuming there's no second wave, or if it's very mild, then the second half of this year is going to be pretty tough. And that's mainly because if we believe what the politicians say, which is a big question mark, then when the job keepers and all those things cease, there's going to be some form of economic cliff. It's getting a lot of press at the moment. And I, for one, am waiting to invest monies post-September, because I think the negotiation power will be stronger. And it'll largely, I'm at the age where my property buying is limited, and I'm buying more shares. But that's not to say, because I'm mid-50s, and you need time to accumulate some assets in property scenes. I'm not saying that I'm chasing income rather than capital growth. We'll talk about it in a second. So the short term, yes, this is a messy year. This is a year that you could basically put a cross through it. But it's also a great opportunity year. Again, on the website, I've written something called "This Too Shall Pass." The headline sums it up. And in there, I argue that why don't you start, if you've got a plan, now's a good time to actually seriously look at buying some stock, particularly stock you can improve. Because like when the GFC happened, and when even GST was introduced, and I'm old enough to have been through, a recession in the early 90s, that everybody was trying to sell property or not buying property. And if you've got cash, or you've got your ducks in line, you could particularly in the latter half of this year, I think, buy some things very well, and maybe better than you'd be able to buy in the next 5 years, maybe even longer.
Sure. Yeah.
Again, that assumes that there's no second wave, and we have China and Australia, falling to pieces in terms of some form of trade thing. And then, I'm not saying you wouldn't buy property, but your strategy about what you do with it might alter. Might have to seriously redevelop it. You might have to actually get more tenants in there than your original plan was. Long term, beyond 2-3 years, the pandemic is just part of the cycle. It's just it was the fundamentals won't change. I do believe that migration will return to Australia and at somewhat high levels. We need their tax dollars. We need the numbers. Our economy is based on growth and expanding markets, not manufacturing and those type of things. We could have a food and a different economy, but that would take major changes. And unfortunately, which this pandemic would present an opportunity that hasn't really been implemented. For argument's sake, the home things that were just, I forget the name.
Home builders grant, yep.
Home builders thing, that's great. It'll get more people to buy a new property versus an older one if you meet the caveats. It'll have better tapware in those people who are going to have renovations rather than those who weren't, because those have to be in play already. I don't understand how the goalposts work in terms of the minimum and maximum you can earn. And it's appealing to the base, and it's politics rather than policy, but it could have been a good opportunity to change some of the fundamentals in the housing market. For argument's sake, forcing the states to scrap stamp duty and replace it with a federally mandated land tax and giving them a portion of it. That would save billions of dollars, not millions, billions of dollars in Australia, and would allow the sales train to start again. In other words, if I'm buying my first property, I'd like to buy a bigger property held by an older person, and those older person might want to downsize and so forth. But stamp duty stops all that. I know we've bought and sold recently, and I haven't done that for a while, and I was like flabbergasted. Even though I do the maths and everything else, when you see it in your face and you see it leave your bank account, you go, "You've got to be kidding!"
Yeah, that's right.
So that's one of those things. The other thing, as well as the process of how something gets approved, is largely ridiculous in a country that's transparent, has rights of appeal. There's not that much, there's no brown, well, there's maybe not in many states,
brown
no
paper
enveloping and all that business. So that could be fixed too, but we've just kicked the can down the road again. And so the fundamentals that affect the property market, demand and supply and so forth, most of us will still reside and move to Sydney, Melbourne, Southeast Queensland, Perth. That's not going to change. I think actually that the talk about regional markets becoming stronger and bigger is not correct, particularly if their employment opportunities wane, universities, tourism, coal mining, and those type of things wane, which I think are happening anyway.
Yeah, that's right.
Then those centres won't be as viable as they are as they have been in the past. And so whilst Mackay's and Townsville's and I'm not calling the Gold Coast or Sunshine Coast or the Hunter Valley or Wollongong as regional towns, they're part of Southeast Queensland and Sydney. But if you say Mackay and Cairns and all those type of things, I don't see them fundamentally changing and people moving there and then somehow magically using Zoom or whatever to conduct business. I can see as nearly everything that's happened in the last couple of months, particularly last month in terms of myself, has been going back to the old patterns of work. When can we meet? When can we do that focus group? When can you present to the board? I'll come and see you when I can travel, or vice versa. And none of that's changed. A few people might want to work Fridays and that kind of happened in South Sea, Sunshine Coast. That happened after the GFC. A lot of people there said, I'm going to work 4 days a week and take Friday off. And I'll put up with 4 days pay, but I'm having Friday off. Whether or not they did, because a lot of them tell me that I've spoken to, so they still work that Friday, but they work from home. So there might be minor changes, but the fundamentals won't change. Short term, great opportunity.
Yeah, for sure. And look, it's been interesting, like you talked about the Home Builders Grant coming out. And I know in this interview, it's only a couple of weeks ago, literally actually just a week ago it came out. And we've been getting basically flooded with interest on our land. We've got a subdivision there in Brisbane there and just getting flooded with interest. So I'm very, very fascinated. Maybe in 6 months' time, we'll do another interview and see, how that's changed. Because I do find, just the light has literally turned on there, but it's early days yet. We've still got titles for us to get, and obviously people get finance to be able to get up these things through. It's one thing to sign a piece of paper, put a $1,000 deposit down, but it's you'd be able to get the finance and settle at the end of the day, and that constitutes a transaction. Otherwise, it's just all pent up excitement, right?
Until the money's till it settles.
Exactly. Yeah.
But one of the things that those type of grants do is it disturbs this normal cycle. So what's happened is people have been waiting. They've been waiting since last year, not because of the pandemic, but they were waiting because this was rumoured that they may do something to do with first home buyers, and particularly in the last couple of months they've been waiting, and so they're now flooding the gate, so to speak.
Yeah.
I don't know what percentage won't be viable in terms of getting finance. It might be low. I think it depends on if they're on JobKeeper and so forth.
Oh, for sure.
And a few of them might, get through. They're really investors rather than owner-occupiers, but there's ways to do that. We won't get into that now. We shouldn't make that public knowledge. And so it exasperates the cycle. And yes, that will create some new starts. I would rather see something that's long-term, that for argument's sake yourselves, that you could make X number of sales per month, and that whilst it fluctuates because you're putting marketing effort in and so forth, it's a consistency thing. So running a building business or a property related business, you want consistent flow rather than, you panic now and 3 months time you're going, well, where's everybody gone? And you've lost people because you're really busy now. Because, as you know, it takes a lot of hand holding. It's a big investment, big purchase. So those type of things could be implemented now. This short-term thing I could understand, and I wrote something about that saying it makes sense in terms of particularly a renovation activity. I would have liked the renovation activity to be allowed to be building granny flats and backyard homes. That's right. Because I own a business that's related to that, but it wasn't. And I think the size of the renovation needed cuts out a lot of tradies.
It does. It does.
So if they were doing a $10,000 or $15,000 or $20,000 renovation, and they could be matched at 30%, or something like that, or 20%, 25% of the cost.
That's right.
That would have actually been good to, the guys with utes running around. That would have been quite handy to those, and the big boys, the building guys. They can really be related to building not first homes, but building new homes.
Yeah, that's right. Very good. Yeah, well, thanks for that, Michael, and look forward to interviewing again down the track, mate. Guys, this has been Michael Matusik. Thank him for your time. Well done, mate. Thank you so much.
Thank you, no problems.
And like you mentioned, go to matusik.com.au to subscribe to your newsletter. Is that right, mate?
Yeah, I'll do this. See? Ta-da.
Oh, very good, mate. Very good. Yep.
You can see how old school I am. It's as fancy as I got. I wrote it on a piece of paper, and even on a piece of paper that I've used before.
Recycled. Good on you, mate. Thanks for your time, and we'll look forward to catching up with you once again.
Okay, bye-bye.